They say that money makes the world go round, but who really has control of it? What if I told you that all this time your money was being controlled by the bank, and even worse, it's working against you, not with you? Well, if you think about it, it kind of makes sense. Banks thrive on your fees and the spread between what they pay you and what they charge others. They pay almost nothing on deposits while tacking on hidden maintenance, overdraft, and transaction fees. Your money becomes a liability when they leverage it into low-quality loans and speculative investments. And they steer you toward high-margin products, Evan, when they guarantee suit your goals, because it boosts their bottom line. The question is, how do we fight back? How do we level the playing field? And most importantly, how do we take control of our money back? Before we get into the nitty-gritty, let me explain my obsession with this topic. When I was 21 years old, I took my first job at a big bank as an intern in the financial engineering group. My primary responsibility was to build models to optimize trading portfolios for the traders on the floor. What this means is that I was trained on historical data and instructed to build a model that would make the best decision possible given the current market conditions. This model, once built, was used by the traders to inform their buying and selling decisions. That means that ultimately I was responsible for thousands, if not millions of dollars worth of trading activity. While this internship gave me a deep appreciation for quantitative finance, it also gave me an eye-opening experience into the tactics large institutions use to generate profits. You see, here's the problem with relying solely on models based on historical data. It doesn't account for human behavior, which can often lead to suboptimal results. For example, let us say that we are building a model to predict whether or not someone is going to default on a loan. We train the model on historical data, we check its performance, and then we send it out into the world. The only problem is that there may be some sort of external event that happens that we did not account for. Take, for instance, the 2008 financial crisis. Prior to 2008, there was a housing boom, and real estate prices were skyrocketing. People were taking out massive mortgages because they thought that real estate prices could never fall. Eventually, though, the bubble burst, and people started defaulting on their loans at a rate that we had never seen before. If we had deployed our model during this time, it would have predicted that people were unlikely to default on their loans because it had never seen anything like this happen before in the historical data. The reality was, however, quite different. This brings us back to the big banks. What if I told you that the reason why they offer you checking and savings accounts with such a low interest rate is not because they want to be altruistic, but rather because they are actually making a lot of money off of something called the spread. The spread is the difference between the interest rate that the bank pays its customers and the interest rate that it charges borrowers. For example, let's say that the bank charges borrowers an interest rate of 6% on a loan, but it only pays its customers an interest rate of 0.1% on their deposits. In this case, the spread would be 5.9%. The bank could then use this spread to generate profit, so the smaller the interest rate that they pay their customers, the more profit they make. In fact, the average profit margin for the 6 big U.S. banks was 23% in 2022. That means that for every dollar of revenue that they generated, they kept 23 cents as profit. It's important to understand that banks are businesses, not charities. Their goal is to make money for their shareholders, just like any other business. And one way they do this is by maximizing the spread between the interest rate that they pay their customers and the interest rate that they charge borrowers. However, there are ways that you can fight back. One way to do this is to switch to a high-interest checking or savings account. By doing so, you will earn a higher interest rate on your deposits, which means that the bank will have to rely less on the spread to generate profit. You might be thinking, well, how much interest am I going to earn with a high-interest savings account? Probably not enough to beat inflation, and that is true. But inflation is not the only thing that you need to worry about when evaluating the performance of your savings account. Sure, if inflation is running at 3% per year, having a savings account with a 0.5% APY means that the purchasing power of your money is decreasing by 2.5% per year. But if you were to compare that same 0.5% APY savings account to an average checking account that has a monthly maintenance fee of $30 and overdraft fees, then that 0.5% APY suddenly becomes a lot more attractive. Not to mention, you also have to worry about opportunity cost. Instead of having your money sit idly in a checking account where it is slowly losing value, wouldn't you rather have it grow in a high-yield savings account while maintaining easy access should you need it. High-yield savings accounts currently range anywhere from 3.5 to 4.5%, which is substantially higher than the national average of 0.37. Even if we factor in inflation, your money is still growing at a rate of nearly 2%, which is better than nothing. Another way to fight back is to audit your statements monthly. Look through each transaction and categorize them. Some categories include things like overdraft fees, NSF fees, ATM fees, fixed monthly maintenance fees, and variable monthly maintenance fees. Overdraft and NSF fees are charged when you try to spend more money than you have in your account. ATM fees are charged when you use an ATM that is not owned by your bank. Fixed monthly maintenance fees are charged every month, regardless of your activity. Variable monthly maintenance fees, on the other hand, depend on certain conditions. For example, some banks will waive their monthly maintenance fee if you maintain a certain minimum balance in your account, or if you make a certain number of transactions each month. Once you know where your problem areas are, you can start to take steps to address them. For example, if you have overdraft fees, you can start using a different bank that does not charge them. Or if you have high monthly maintenance fees, you can look for ways to reduce your expenses. The third way to fight back is to negotiate or eliminate these fees altogether. Many banks will waive fees if you ask nicely. In fact, a study found that 41% of people who asked their banks to waive overdraft fees had their fees waived. Banks are businesses, and they want to keep customers happy because they do and want to lose their business. So don't be afraid to ask for what you want. The worst thing that they can say is no. So why don't you just cut out the middleman and hold your cash at home? Well, the problem with holding cash at home is that it is not very safe. If your house burns down or you get robbed, you could lose everything. And not to mention, if you want to earn interest on your cash, you need to find a vehicle that offers a higher interest rate than inflation. And as we all know, good investments do not come without risk. In conclusion, banks are businesses that exist to make money. And one way they do this is by offering checking and savings accounts with low or no interest rates while charging high fees. However, there are ways to fight back, switching to a high-interest checking or savings account, auditing your statements monthly, and negotiating or eliminating fees altogether. Each of these methods can help you reduce the amount of money that you lose to the banks. By taking these steps, you can start to take control of your money back. But wait, there's more. There is one more thing that you can do to ensure that you are not getting ripped off. A study conducted by NerdWallet found that nearly half of Americans said that they would switch banks for a better savings account. A full 48% of those without a high-yield savings account said they would consider switching. Another study conducted by Bankrate found that 34% of Americans are planning to switch banks this year. The top reasons cited were higher interest rates, lower fees, and better customer service. If you're considering switching banks, I'd recommend checking out this video next where I discuss the 5 best banks of 2023.